Welcome, everybody. My name is Greg Michalowski, and today is May 30th, 2011, and we have, it's a Memorial Day here in the United States. That's a holiday here in memory of those people who have fallen in war, and right now in the United States they're putting a wreath, the President's putting a wreath at the tomb of the unknown soldiers. If those people out there have a news station on, you may be seeing this around the globe. Who knows? I don't know, but this is in Washington D.C. and this is in memory of those soldiers. This memorial, just as a guide, I'll speak a little bit about it. It's American. This memorial is for those soldiers who have not been identified or lost, missing in action. And it's a very solemn place. It's on guard 24 hours a day, 365 days a week, and it's for those people who ever get to Washington, which is a great city to visit. I hate to digress here before we get in, but Washington's a great city because everything is, all the national monuments are free to attend. So it's really neat. If anyone ever wants to visit, send me an email. I'll tell you where to stay too, with a nice transportation, and you don't have to stay necessarily in the city. You can just stay right over the Potomac, and we found a nice little hotel when we went there. Anyway, I'm here today to talk about where does fundamental analysis fit in your foreign exchange trading. Before we get started, let me remind everybody that we do have a disclaimer that we're here just to give you education, and not here to give you buy or sell recommendations or to in any way try to influence, I guess, your trading one way or the other. They are opinions, and opinions are just that, opinions. So we hope that you learn from it, have some experience in the market over a number of different years, and hope that goes toward, or that is at least taken into consideration in what I have to say here today. Anyway, that's me on the right. Sean Powell, my partner, is on holiday here today, and so he won't be able to join us, but I do have a Twitter, twitter.com, GregMikeFX. If you want to subscribe to that, you're certainly welcome to do that, and Sean has his Twitter there as well. So when I think about fundamentals, about knowledge, fundamental analysis is about knowledge, and just in general, knowledge is power. Knowledge gives human beings the ability to think on their own 2 feet, to be able to solve problems, to be able to get from point A to point B, and so it is some power. But what you have to do with that knowledge is include an application. If you have knowledge and you don't apply it in something that you're doing, then what good is it? And what good is that knowledge? And then it has to help you as well in that knowledge. For instance, I could show you all that you ever want to know about the U.S. unemployment report, which is going to be released this Friday in the United States. This is a fundamental piece of news, a main piece of knowledge about the economy here in the United States. And it doesn't necessarily have to be U.S. It could be any country's unemployment report. And for instance, you can take a look at the history of the non-farm payroll. And this is the last recession, 1980, 1984. And it shows the number of jobs that were lost during that recession, during this period right here, this non-farm payroll from 80 to 84. And you can see that we had some lost jobs here, then gained some jobs over a 12-month period, and then a year or so of lost jobs, and then a rebound. And we compare this to the current situation in the United States as far as non-farm payrolls, similar type of action over here, and then huge losses here. Compare the scales here, 850,000 jobs on the downside. Do we get anywhere close to that during the 80-84 recession? Of course, there's less people in the United States at that point, but on a relative basis, quite a difference here. In addition to that, the rebound here off of the recession, we had a month where the non-farm payroll went up nearly 1 million jobs in the United States. Have we gotten anywhere close to that? This surge right here was as a result of census workers, temporary census workers, that led to these declines back here. So really, this is the meat of the job growth that we've seen in the United States, and pretty tame in comparison to this 1980 point where, again, there was less people in the United States, but we are gaining 350, 400,000 jobs during this session right here, and haven't come anywhere close to that in this. So that's some fundamental news, some knowledge that I can impart on you. Historically, the U.S. employment rate, you can take a look at unemployment rate as well. Chairman Bank a few months ago said that it would take 4 to 5 years for the unemployment rate to come back to a normal level. Well, what is a normal level? And how many months since July of 1970 has the unemployment rate been below 6%? What has been the average unemployment rate since 1970? I use 6% because it seems, you know, nice level. That's what the Bernanke was talking about. And 253 months, or 52% of the months since 1970 has had the unemployment rate below 6%, and the average unemployment rate has been 6.31. So when the Bernanke talks about the unemployment rate getting back down toward this, what is normal would be 6.31%, I would say, since 1970. You can see why it may take 4 to 5 years for that to happen, and you may even be skeptical whether it can get down to that level at any point in time, especially with hiccups that we've seen. Oh, you take a look at non-farm payroll jobs. You know, there's another look of it, or private sector jobs. We can cut down all the fundamental news into all its little different little components by taking a look at the goods producing sector, which sectors are adding jobs, which sectors are not adding jobs. Construction, of course, is still down. Manufacturing is showing some rebound. We can look at service producing, and I say some more of a service producing economy. And you can look at how financial jobs, you know, just haven't gotten off the ground yet. Professional business jobs, however, are increasing. That's good news. And most of the jobs have come in the form of the healthcare here. You know, other little sectors of the United States. You can kind of look at the fundamentals and look at the knowledge that you can gain from these, from all this data, but you have to apply it. This is a current chart of the private and sector employment change versus the initial claims for unemployment. And what we've seen of late in the United States is that the initial claims for unemployment has been rising. Rising. That means that more people or the initial claims for unemployment are rising, so that means more people are out of work. And this estimate for private sector jobs come this Friday is expected to be around 210 or 220,000 jobs. Does it really make sense to have 220,000 jobs when the initial claims is expected to be at this level, or is at this level again when we only added about 143,000 jobs? That's going to be the big question this week. That's going to be the big that's how we apply the knowledge this week into the trading, into the fundamental picture into our trading here today. And it doesn't seem like 220,000 jobs could be created with this move to the upside here. Now, it may be as a result of bad weather in the United States. They may make excuses for it, but the estimate is still 220,000 jobs, and you'd think that they would take into consideration that type of look at that and take into consideration those factors, the weather, in their estimates. But the economists who have PhDs and who model these the unemployment are still saying that the unemployment rate or the non-farm payroll should add, or private sector payroll should add around 220,000. We will see. And so with all that knowledge, does it give the application? That is, does it give you a buy or sell for the euro versus the U.S. dollar? And because that's what we're concerned about as a trader, isn't it? Whether we should buy the market or sell the market, given all that knowledge about the unemployment situation, things like initial claims and so on and so forth. And that's debatable. So it doesn't necessarily work through. So, but anyway, let's just assume that we decide that the private payrolls will be 140,000 and not the 220,000. Do you buy the euro or sell the euro? And most people, would look at that question and say, well, what do we know? Well, we know that the job growth is weaker. We also know the Fed will not likely tighten anytime soon. And we also know that things like the dollar tends to get weaker if the Fed is on hold for an extended period of time. Job growth is weaker, spending is weaker. All these things, maybe deficit actually grows. Why? Because of less tax revenues. Housing market continues to weak. All this, is not good for the U.S. And we can make this judgment by taking a look at things like the past and seeing what happened when the fundamental information, the application of the fundamental news, what it did to things like the U.S. dollar. When we look at last month's private payroll, which was stronger, and we take a look at the euro versus U.S. dollar, what happened with the euro versus U.S. dollar? Well, the euro went down, the dollar went up. With the strong, as a result of or possibly as a result of the stronger private sector payrolls and non-farm payrolls that we had last month. This is the day of the employment report, and the prior day we were already on our way to the downside, and the market then fell below our support level here. Nice support line, nice little channel here, broke above the channel, broke below it here, and took 2 days to get back below the bottom side of this channel. Trend line on its way down to the lows that we saw last week. That's, by the way, stopped right at this blue line right here. Anyone know what that blue line represents? Who have listened to me before? What does that blue line in all my charts represent? Nobody? Type it in. I'll give you 5 seconds. 100-day moving average. You're correct. This is a 100-day moving average. It's a simple moving average. It's off the 5 p.m. New Year close. For those people who may have other charts that look different than my chart, the 5 p.m. close is the official closing day of the foreign exchange market, and that's when new spot positions change their value date. If you do a trade at 5:01, for instance, the spot date will be 2 business days from the next calendar day. So if you're in New York and today's the 30th, and if you deal at 5:01, 30 days have September, April, June, and November. May is 31 days. So we'd be dealing for the first second. So whereas today we're dealing for the first. So you get it. So that's why we at FXDD and most of the major things like Bloomberg use the 5 p.m. close as your 100-day moving average. But yet last week we went right down to the 100-day moving average, moved higher off of that level. So that's a key thing. That's a technical thing. We're not talking about technicals much here today. So, but if you're just talking fundamentals, you might say, but wait, that employment number, that 140,000 jobs, that knowledge that we're getting from the fundamentals, depends, or our trade, whether we go long or short the euro, depends on other things as well. For instance, we can say that, Greece is in the news, isn't it, lately? What about Greece? What about, are they going to, find what is the IMF going to, say in the report about the Greek, where they are as far as their austerity measures go? What do they have to do? Are they going to get support from the EU or from the ECB? What is the implications of all that situation in Greece? And we have Portugal, we have Ireland, we have Spain, we have all sorts of things, sort of the weak sisters within the Eurozone that may affect the value of a currency. So we would think that if we get a weak employment number, that the U.S. dollar would actually get weak. So the euro will go higher. But what about the implications of things like Greece, Portugal, Ireland, which are a negative, or should be a negative toward the value of a euro? And with regard to Greece, I mentioned things like the IMF, the EU, and the ECB are going to be contributing factors. Last week we saw instances where there was comments of the IMF, in particular from things like EU member Juncker, who said that a payment to Greece was not going to be forthcoming from the IMF, and that sent the euro down. Those people may have gotten hurt in that trade. That's a fundamental piece of news that caused the euro to go down. Of course, then the market in the euro rallied on weaker U.S. data, apparently. But so you have to be careful about what happens, and a lot of times the market, in regard to fundamental analysis, is influenced by a lot of things. Also, it may depend on things like oil, gold, and commodities as well. We saw gold prices and silver prices move higher, so a lot of times that leads to a lower dollar. That's what the movement has been. And it may be that there's problems in Greece may also lead to a move higher in things like gold and other commodities. So that is another factor to consider in your knowledge of what it goes on in the market. And finally, the U.S. employment number will depend upon a survey that will provide a proxy value for the number of jobs created in the economy. With 310 million people, the same amount of people will probably watch the Barcelona versus Manchester United game this weekend. So, finally, it'll all depend upon what is the demand and supply balance in the market. So there's a lot of things that go into fundamentals. You can sit there and highlight the employment situation and know everything about the U.S. employment situation, and then you start to add all these other influences in it, and it causes you to question the role of fundamental analysis, at least for me, as a tool for your trading to where you think the market may go higher or lower. I'm not saying that it's not important, folks. Don't get me wrong, that fundamental analysis is not important. What I'm saying is that there's a lot of things that go into it. And so fundamental provide knowledge, and it's mainly after the fact. You hear a story and it provides that knowledge for market direction, especially in the shorter term, but it does not necessarily provide a guarantee that the market will do what you think it should do. It does not provide a guarantee that the market will do what you think it should do. And that is an important thing. Well, what do we know, however? What you can generally say about fundamental analysis, the fundamental foundation, I call it. If the economy in one country is more bullish than another country's economy, that country's currency should go higher when compared to the other country. That's sort of a generalized view of fundamental analysis. But even when you say something like that, there's always some question as far as whether or not that really makes sense. And as an example, the ECB GDP forecast is supposed to be 1.7%. Well, the FOMC's GDP forecast for this year is supposed to be 3.1 to 3.3%. So why is things like the euro continuing to move higher? Now, I know we've had a correction of late in the euro versus U.S. dollar, and so maybe this trend to the upside is moving to the downside, but it doesn't necessarily, just growth doesn't necessarily mean that one country is going to be more stronger than another country. And I think what I've already sort of talked about in my discussion so far is there's a lot of things that go into the equation. There's a lot of things that go into the fundamental pot, if you will, that causes a currency pair to move. Like economic releases, durable goods, retail sales, industrial production, inflation, unemployment, GDP growth, all these economic releases. Then you have the interest rates, which I think is probably one of the more driving influences in the markets here today. We'll talk a little bit about that a little bit later. Intermarket relationships like gold and silver and stock markets, oil and commodities, all of them have an effect at fundamental. We have fiscal policy. We have the U.S. Debt situation in the United States, which is obviously a negative for its currency of late, and has led to, someone may say, has led to the decline in the U.S. dollar, along with monetary policy. Balance of payments. What do we see in Switzerland last week? We saw a better trade situation, and that caused the Swiss franc to continue to be strong. Currency flows by corporations. We saw this during the tsunami earthquake in Japan. There was talk of repatriating of funds back into Japan after the devastation of the hurricane, of the earthquake and tsunami that caused the yen to rise dramatically against the U.S. dollar until we had intervention from the central banks. Mergers and acquisitions could cause flow of funds to move one way or the other and cause a currency pair to move up or down. We have things like weather and natural disasters that cause a currency to move up or down. We have war, we have rioting, we have politics, we have money supply and the velocity of money increasing or decreasing. We have things like consumer confidence, hedge funds, insurance company activity, illegal activity, what people say. I don't even think I put monetary policy probably goes into interest rates there as well. But this is just a small list of what goes in as far as fundamental analysis that I like to say the stories behind the moves in the market, what you would hear on your business channel, what you would read in the newspapers or online in the different news websites that you have. I get called periodically from places like the Wall Street Journal or Reuters or Bloomberg, and they're asking my opinion of the market. Well, guess what? They don't want to hear about my technical opinion. They want to hear about the fundamental picture of the story. And so I'm forced to give them a fundamental picture of the story, or give them the story that caused the market to do X, Y, or Z today. But that same story, or that story that should be controlling the market, may be changed tomorrow. Why? Because instead of focusing on things like interest rates, they're focusing on things like rioting or politics or war or what's going on in Greece. And so all this may cause a shift, a balance from one to another. I liken the fundamental market to being something like a big cauldron of where a witch's brew gets concocted, and all the fundamental ingredients go into the pot and determine the market direction. And that direction overall can take a long time, and you have to be right after that long time. If you have a fundamental bias to the market, and that is the reason for your trade, you better be right. You better have all those influences, and you may narrow it down a bit to certain few instances, but in the meantime, you better be right. And when the party's over, you better hope that the market ends up doing what you think it should do. Otherwise, if you're wrong, it can be devastating. It can be devastating to your trading. For example, let's take a look at the euro versus US dollar here. Equivalent. But what do we have last week? We had the market come down to our 100-day moving average. We know that from a technical perspective. But we had a week where a lot of the focus was on, at least in the Eurozone, on this Greece situation, on what may happen. And typically that would be bearish for the euro, wouldn't it? I would think so. I mean, if that's what I was focusing on as a trader, that we know that Greece is going to have problems, that it's likely. We know through the interest rates that their interest rates are continuing to be high, which means that the market is not necessarily betting on some positive news coming out of Greece, and so this would suggest that there's going to be some other actions that they're going to have to take in the form, and we've heard, if they're going to take or try to take actions in the form of increased austerity measures or possibly sale of private of assets. Well, they've been talking about that for a year now, and nothing's necessarily happened. So we're not going forward in that situation. But if you were to focus on just that fundamental story and make the judgment that the Eurozone or the euro should be weaker as a result of problems within Greece, what would have happened? You would have seen the market move up 1, 2, 3, 4 days from the low on Tuesday, Wednesday, Thursday, Friday, and your sale down here might have been influenced by the fundamentals, and the market moves strongly to the upside. So it's difficult as a trader, in my mind, to be able to sit there and pinpoint what you should do, how you should look at the market, and what decision you may have. Now, that trader who may be short for one reason or another may or for something like the Greece situation or banking or concerns or the demise of the Eurozone or whatever, it may ultimately be right. Recall a year ago when the euro was at However, what I want to warn that is recall a year ago when the euro was at 118.76, and I can go to the newspaper articles and look at the news and look at the reports on television and such. And at that time, when the euro was at the low, because of Greece, what was the market pundits saying? They were saying that the euro should go to parity, weren't they? They were saying that that Greece is going to force the euro to have this crisis, and the euro should go to parity. Well, at 150, they weren't saying that. Now they're saying that the euro has the ability to move higher. Granted, there's a lot of other things that go into that pot, folks, that cause the euro to move higher and the dollar to move lower. Mainly, probably that the dollar move lower, but you get my point, is that a lot of times the fundamentals can be what I term ambiguous. They can, if you focus on the wrong thing, you can have the market go right in your face and go the other direction without knowing what exactly is happening and why it happened. So you have to be careful with fundamental analysis. But there are some main driving stories or driving influences in the foreign exchange market. Let me take this. There we go. The main drivers of the story that tend to dominate include interest rates and lately commodities. Commodities tend to cause some influences in the market. So I thought I'd take a look at some charts here just to show you an example. This is the Aussie versus U.S. dollar, and clearly this is a commodity driven economy. They have a lot of natural resources, and what we're seeing with the Aussie versus U.S. dollar is a move higher, consolidate, a little corrective move higher, consolidate, move higher again, a little correction, but still the trend is to the upside here in the Aussie versus U.S. dollar. Not only are they influenced by commodities in Australia, but they're also influenced by interest rates. And Australia has been steadily raising their interest rate. Well, not lately, but they have raised the rates up to 4.75, the highest of all the industrial economies that we do tend to look at. And so all of this has helped contribute to a strong Aussie versus U.S. dollar. There's no denying that. Interest rates and commodities, interest rates increase, that is monetary policy tightening, and commodity prices increase, help commodity currencies like the Aussie versus U.S. dollar. Taking a look at commodities a little closer, if you take a look at this is copper, and copper, when copper prices go up, that's the orange chart right here. What is the Aussie versus U.S. dollar? It goes up. Look how close that those are correlated. And so you get to see, from this chart that there is a lot of correlation in between commodity prices and the value of currency. Note here, however, the commodity prices increased here, and the Aussie versus U.S. dollar kind of stayed stagnant here. So commodities moved higher, and then we saw the Aussie versus U.S. finally give in and start to move higher at this point right here, only to have the commodity prices come down. So it was almost like the currency sort of knew what was going to happen here, but then ran out of steam. So this type of movement where the market moves away from its baseline here can cause some problems from a fundamental perspective or from a trading perspective. Looking at that fundamental, looking at that, looking at this chart and trying to decide, what is right? Is the currency right or the commodity right? And so you can get into a situation where you get a little bit off base here, and you can kind of get whipped around, can't you? So you have to, again, it demonstrates the the ambiguity of sometimes fundamental news on the value of a currency or currency pair, and focusing too much on the fundamentals may actually cause you to have some issues or some problems with your trading. So be careful. Be careful. Even when things are very highly correlated, it could cause some issues. Let's take a look at gold, and what we've seen of late is gold prices move higher. And if you take a look at the euro versus U.S. dollar, I'll go back and forth with these charts. You see a very similar pattern. The euro goes up, that means the dollar goes down. So again, gold prices, nice steady move to the upside of correction of late, and the euro prices steady move to the upside, correction of late. So building on to is that as gold prices go higher, you tend to see the dollar get hit. Now that doesn't necessarily have to play out. For instance, if you take a look at the gold late, this move to the downside. It seemed like the euro went a lot more to the downside here than what we saw in gold move to the downside. In fact, gold has been moving back higher of late, while the dollar hasn't necessarily gotten all that much weaker here. So we're seeing actually a shift of the story, aren't we? We're seeing a little bit of a shift where the euro goes down. Why? Because of the problems in Greece forced the euro to the downside, and gold, it doesn't care whether there's problems in the U.S. It can still be a safe haven currency, and I think that's why we're seeing gold prices kind of rebound a little bit more than what we saw the dollar get sold off, especially against currencies like the euro versus U.S. dollar. If you take a longer term perspective of gold, this is sort of demonstrating that idea. Clearly, since 2008, we've been in this uptrend in gold. There's hardly a corrective move worth noting of seriousness. This is probably the biggest correction here at this point right here. And it probably stayed pretty much above the trend line there. Just fell below the 100-day moving average just briefly, but most of the time since 2008, the market's been above this 100-day moving average. And look at the green line. By the way, the green line from a technical perspective is a 200-day moving average. And since this point right here, going all the way back to 2009, beginning of 2009, market hasn't been below the 200-day moving average the whole time. So that suggests something about the trend in gold. But if you take a look at the same chart, there's our gold moving higher, and I've overlaid the dollar index here. What you see here is that even though the gold prices go higher, we've had instances where the dollar went higher and gold prices went higher at the same time. So this is more up and down. This is more to the upside here. So it suggests that the ambiguity of some of the fundamental news that you look at. Anyway, I want to take a quick look to end up and then answer some of the questions that you may have. What are the global stories that are driving the fundamentals in the economy right now? And in the U.S., certainly interest rates are likely to remain stable. That's keeping a bearish bias on the dollar. We have increased debt, government deficit, and debt reduction problems within Congress. Are they ever going to come to a solution? What kind of solution will they come to? Is it just going to be a lot of the usual politicking? Unemployment remains high, around 9%, and housing is certainly a concern. So all these suggest a weaker dollar, and that's probably what we're seeing is a focus on the U.S. policy toward a weaker dollar, whereas in the ECB, despite the fact that they have issues within Greece and some of the weaker sisters, the ECB has taken the stance that interest rates are likely to continue to increase. Why? Because inflation continues to remain a concern in the Eurozone, and so with the mandate for the ECB being inflation, interest rates are likely to increase. But we do have the wild card of Greece, Ireland, Portugal, and weak sisters within the ECB, the Eurozone, which could cause temporary weakness in the euro versus in the euro as a currency as a whole. In the UK, we have obviously inflation that's well above their target rate, and the Bank of England seems to be more concerned about the growth than they are about the inflation. And so, but they go back and forth, and there's talk, in fact, today that the UK may have to, the Bank of England may have to give in to that inflation and look to raise interest rates. So that's kind of an in-between currency. We have the U.S. down with looking to likely to keep rates steady. ECB likely to raise rates. The UK kind of sitting on the fence between. Switzerland, the IMF called for raising Switzerland's rates last week. And we saw some fundamental reason why they should do that. The trade balance continues to what was a larger than expected surplus last month. That's not exactly what you'd expect in a situation whereby your currency is strong, and as a result of that that and the fact that the Switzerland is a safe haven currency, think of it as if the Germany wasn't in the EU, the German franc or the German mark would be much stronger than will probably be the strongest currency in the world, and the Swiss franc is now that safe haven currency, that currency that's not tied to the EU like the German economy. As a result, we're seeing the Swiss get stronger. Japan's rebuilding. We have all the uncertainty as far as the rebuilding from the tsunami, from the earthquake, and so this is going to cause their currency come in flux. What we've seen is that the Japanese yen becomes a safe haven currency in times of uncertainty, and so we're seeing those types of flows. Canada expected to increase to the year end, and we did have some GDP data come out of Canada today, which showed strong growth, but the strong growth was somewhat not good strong growth. Why inventories increased caused the rise in the GDP, and consumers start to pull back as far as their spending goes. So there's some question as far as what may be going forward in Canada. The second quarter is supposed to be weaker. Third and fourth quarter are supposed to increase a little bit or increase again, but that's still in question. Australia, probably the most bullish currency. Why? Because interest rates are expected to rise. Commodity prices continue to rise. And New Zealand's gotten a boost of late by talk of China investing within their economy. Rates were lowered to 2.5% as a result of the earthquake that they had there, but the higher currency is a drag on their economy, but higher commodity prices and lower imported prices, they rely on imports as well, has helped things and ease some of the burden from the higher currency. So those are the fundamental perspectives in the economy. What I do have to finally continue to warn, however, is that what you have, one of the big problems within looking at fundamentals is being able to define what goes into that pot, what figures out whether the currency should go higher or lower, and what the market is focusing on at that time. And what that means for you as a trader is that you do have to be able to sustain losses and kind of be understand that you can't go back and forth with the market ebbs and flows. And for me, as a trader, as someone who represents, let's say, retail traders out there and trying to think to give you advice, I think that's a dangerous way to look to trade the market, is purely on fundamentals. What I prefer, and the way I use fundamentals in my analysis and in how I educate people, is by taking the view that fundamental analysis is good. All right, it makes you feel. It gives you knowledge, but you have to apply that knowledge in an application that's going to allow you to make money as a trader, and that's what you as a trader have to do, is be able to make money. That's your goal. That's your mission statement. And so from that perspective, can you take the fundamental news, fundamental perspective, and apply it to your trading and be able to keep things like fear and risk under control? And my assessment and what I've found is that if you're too fundamentally oriented, if you use fundamentals as your primary tool, what the risk is that you can't define your risk. You can't say unequivocally that this is my stop loss. And that's a danger for a retail trader, is getting to that point where you can't define your risk. And as an example, I contrast that with technical analysis. And technical analysis allows a trader to define their risk. So you can be bearish the euro at this point right here, or through these points right here. We went through the trend line, formed this, went through the 38.2%, found support, moved back below the 38.2, and formed this channel here. When the market came back to this level right here, had a trend line, had a parallel trend line here, had the 100-day moving average there. Were you able to define your risk? Yes, your risk was defined against these lines right here, these points right here. As a trader, you're able to say, if the price remains above these points right here, I'm bullish. If it goes below, I'm bearish. And that is the difference between technical and fundamental. the fundamental story on these moves to the downside were pretty much the same. All right, there hasn't been any major shift, if you will, in the fundamental story. Yes, the focus moved from dollar weakness to euro issues, or maybe it's just been technical things. Yes, that caused the euro to move down, but the fundamental, the overall fundamental story really hasn't changed a lot over an extended period of time at all in the global economy. It's still risks. There's still, the central bankers still kind of tell the same old story now. Now the euro, they did raise rates, and they started to not raise rates during this period. Maybe that led to the euro decline. But the point is, folks, is that from a technical perspective, you can define your risk against this line. From a fundamental perspective, you can't. You can't. I don't know how you can, but you cannot define the markets going down. So in that respect, what I choose to tell people and educating them is this: is that the fundamentals can become a secondary tool. They give you the encouragement, they give you the confidence in the directional bias that you may be trading at that point. But they should just be used as such, a secondary tool that you don't base your trading decision on, that you instead use to support your trading decision. And if you do that, you're able to have the best of both worlds. A, be able to understand why the market is doing what it does by following the story, and B, being able to define your risk, keep your risk to a minimum that allows you to perhaps be a buyer against a 100-day moving average when people were selling from a fundamental perspective, and being a buyer during this sessions right here against that 100-day moving average. Why? Because your risk is defined, your risk is limited, and then being able to take advantage of the move to the upside. So from a technical perspective, you see your lines, you see your points, you define your risk. From a fundamentals perspective, you're kind of a little bit, you could have some ambiguity in how you look at the market. And what does ambiguity do? Increases your anxiety. What does your anxiety as a trader do? Increases your fear. And what does fear do a trader? Fear is a trader's worst enemy. You got to steer clear of fear. So that's it as far as my look at fundamentals, where it fits in, what I think fits into a retail trader's mind thought. It's sort of there's nothing definitive about fundamentals. You can have an idea of where it may go, but you have to be careful in applying it in your trading. So let me see if there's any questions here, and I'll take a look. And if anyone has any other questions or wants to take a look, we have some time here. If you want to take a look at a currency, maybe get my analysis. It is a kind of a quiet market here today. The euro is trying to stay above this and continue its move to the upside here by staying above the upper channel trend line. That trend line comes in at around the 73 level here, so that's somewhat positive. Off the hourly chart, we're just showing a sideways here. We did have this channel here. The market's kind of moved a little bit below. So let me see. The U.S. is in serious trouble. Yep, you're right. It does seem that way. There's a lot of negative housing, debt situation, the employment situation. That chart of the unemployment rate, although it's come down, it's still way up there, isn't it? And that is what you worry about is any sort of move into the negative. Things like oil prices moving higher, or as we head into the summer driving season or summer vacation season, could cause a family to say, "Hey, we're not going anywhere. We're not going anywhere. We lost our confidence in the economy." It's that fragile, so you have to be really careful about what goes on there. So if you want to have that fundamental perspective that the U.S. economy is going to be weak, the Fed's going to be on hold, then what you should think is that the dollar should decline. And so what you have to decide is against what currency might that be, and also where your risk is. And from that perspective, you have to use things like your technical analysis in order to define that risk. in my opinion. If you look, we are making higher lows on the unemployment rate in 1998, so might not hit the '07 low again. Yeah, if we're making higher lows on the unemployment rate, so higher lows. Yep, you're right. Poor education, overseas hiring, it's not likely in the U.S. Right. The unemployment rate among those people who don't have an education in the United States is much higher than it is for people who have an education. Overseas hiring, those jobs are hard to come back to the United States. There is some shift because of the weaker dollar that makes some reports, some anecdotal reports that the U.S. is getting more competitive abroad because of a weaker dollar. Whether that is by if that can be sustained, that you can still run a weaker dollar and be able to float your debt, the huge debt that we have is a big question mark. So it could all backfire, and it's kind of the U.S. is kind of on a tightrope here and hoping that things don't fall apart. That is, we don't lose buyers of our debt. If you run high deficits, you need buyers of your debt. Deficits from a trade standpoint, from a domestic spending standpoint as well. So you have to be careful. Dilute the money so much that people start to owe us money on our debt. Laughing out loud. You're right. More concerned of the psychological profile of the next head. Laughing out loud. Yep. So what is a trading decision to be taken on the news? Just sell or buy and follow technical levels. Good point, Manny. Yes. Well, here's how I approach the unemployment report as an example. Okay, is that if I don't have a position that's in the money, that's profitable, then I consider it just flipping a coin, and you might as well just go to the casino and bet red or black. Okay. So that's my opinion. Okay. Now, what I will do, however, on through the unemployment number is define the levels, define the key technical levels. And so if the market was trading at this point where it is right now, I would say, okay, this trend line, which had 1, 2, 3, 4, 5, 6, it moved above and then used it as support and then moved below, used it as resistance and moved above. Friday was kind of a volatile day. And today we're trying to use it, but, this is a hard day. But let's say I was using this trend line right here. I'd say it's bullish above, bearish below. That's one thing. And then I would start to look for targets along the way. So if it's bullish, we have to get above this high right here. That's our first target that we have to get through. I might draw a trend line that connects these highs right here, or something along those let's say like right here, and target those levels. So I start to target upper levels and lower levels. On the downside, I look, this is a nice floor. I would look at this level right here. This was an old high. Look at 38.2% retracement. This moved to the upside. So I'm going to define all my levels, and I'm going to trade it from a technical perspective. So, for instance, if we go to the downside, the market breaks below the 142.57. I would be bearish, and then I would look for the market to hold that 57 level. If it holds it, then we should go lower, and we should head to the next target level, which is the 04 level. And once we get to the 04 level, we should look toward the 100 and the 200 bar moving average, toward the 38.2. So all these levels become target. Then we get to this trend line right here. So you map your route out from a technical level, and by defining those levels, you get to see where you're going and whether or not you reach those points. If you reach those points, then everything's okay. The trend continues. So you have to start somewhere, and you start with your bullish and bearish bias, and let the market tell you what it is thinking about the report. I can guarantee you one thing: they will have the story in the newspaper tomorrow, on the website today, after the report. That's going to tell you which way the market went. You don't care about that, all right? What you care about is making money and for the market to move in the direction of where you're going. And so that's why I always follow the technicals. But good question, Manny. I hope that answer helped you a little bit. Do you think we'll see further yen repatriation as Japan economy weakens? What we saw in the in my mind, in the dollar versus yen, is that what do we have? We had that repatriation, right? That trade. It was a trade. It wasn't. I don't actually think that the funds were being repatriated at this point right here, where the dollar yen went screaming to the downside. That one day where it lost 5% in the first 10 minutes at 5 o'clock was kind of a trade. It was a market got out of whack, went through the all-time lows, and then we had the intervention here. This intervention right here took the dollar yen screaming to the upside and allowed the repatriating of the funds to happen at a better level. If you look at this high right here, this was the highest level going all the way back to September and August of 2010. So we had the intervention that did its thing. It was supposed to give an out for any companies to repatriate some of the funds, and I think that's it. Once they were able to do that through support from central banks and this move to the upside here, then it's back to fundamentals and following what the market really thinks. Okay, so they gave them an out, they allowed them, but I don't expect any sort of intervention here, intervention in the market anymore. It's kind of back on your own type thing, a rebuild. So I think it's probably been done. So. We'll see. It's still a tricky thing. You don't necessarily should expect if they're going to have a weak economy to see, and especially since it's an export-led economy, to see such a strong yen. But don't fight it. Don't fight the trend. Look at the 100-day moving average, folks. We held the 100-day moving average last 2 weeks. And last week it finally gave up and started to move to the downside. So again, watch your technical levels. The technical levels give you the clues, and right now we're below that trend line. Yes, dollar Swiss, if you could. Interested in these all-time lows in the dollar Swiss. I would assume that you're interested in buying the low in the dollar Swiss. Because it's lower. Is that right? Yes or no? D-dub. Are you still with us? Are you interested in buying or selling the dollar Swiss? Yes, buying. All right. The thing about that you have to be careful is everyone thought the dollar Swiss was lower here. It was low here. It was low here and low here and low here and low here. And guess what? It hasn't sustain any rally. So this is a major trend right here. Now let's zoom in here and take a look at this. When I have a major trend like that, I'll break it down and say, okay, let's see if we can get above 38.2 of just this last leg. Again, remember, this is just this amount of this. Very minor, right? Very minor thing. So what I'm looking for is, okay, we bottomed here and we started to move higher. We got to get above 38.2. Okay, now we have this trend line and we have this 50% retracement. And what did we do? It held it. Couldn't get above the 50% of just a small move to the upside. And so you could say, well, what good is it? And look how the market held this trend line here. It went a little bit above it and then fell below it and said, and what do we get? 4 or 5 days straight to the downside. This target, if below this line right here is bearish, there's no reason in my book, all right, to buy the dollar Swiss unless it gets above this high. All right, and can sustain above that high. And then we have to get above this trend line. And then we have to get above this longer-term trend line. And then that will take us to the 38.2. And then we have to get above, so that's what you have to map out, is you have to have a reason to buy the dollar Swiss. Otherwise, you're just guessing, okay? And the reason to me is above, the first reason, and the only, is above, getting above these lows here. If you can get back above those lows, you can define your risk. But you only stay long, in my book, if the price can remain above this low here. If it goes above it and then comes back down below it, you can see this market continue to move down. So if you don't want to sell the dollar Swiss, which is hard to do, although the technicals say we could go down to 82.57, this bottom channel trend line. If you don't want to sell it, and if you sell it here, by the way, you can define your risk against this if it goes above here, right? So if you don't want to sell it, then don't buy it unless it moves above this, in my book, or we go down to test this trend line right here, and then you could buy it here, because this is all-time low. There's really nothing that you can go against. You can buy it here with a stop below there. So you have to be able to define your risk. So that's the only thing I can really suggest in dollar Swiss. Wouldn't you want to be selling at the bottom? Selling at the bottom is so low. Buying at the bottom because it's so low, right? Well, my point is that it was low here, and 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 it kept on going lower. The dollar versus Swiss, that is. So Swiss franc's been strong. The dollar versus Swiss has been weak. So yeah, it could go lower. It could go lower. It could. Why? Because if they raise the rates, it could go lower. I have one more question. Would you suggest that fundamental analysis is important only for bigger picture while technicals are good to place your trades, money, risk management? Yes. Yes, you could, but you have to be right. If you're going to take a longer term, bigger picture view of the economy, Phil, or of a currency pair, you have to be right. Because it could go 300, it can go, let's say you think the dollar should go lower, and the euro just went down 800 pips from the high to the low. It went down 800 pips. That is hurtful. That hurts your wallet, doesn't it? So you have to be really careful of taking a longer-term perspective as a retail trader, unless you manage your money and you only use, like you say, well, I'll live through 300, interim point decline. Make sure it doesn't take more than 5% of your account value, because that's what proper money management, in my mind, should be. All right. Anyway, I didn't get to all your questions, but I am out of time. I want to thank the people at FX Street. Thank you, Vicky. Thank you, Lord. Wishing all those families in the United States who lost loved ones in the war peace here today, and wish for peace around the globe as well. Why not? We don't need be a better world with it. So, God bless everybody. Take care. Thank you, Vicky. Thank you, Maud. Thank you, Adinda. Thank you, FX Street.